Hi, welcome back to Money, Money, Money. Kirtan Shah of Credence Wealth Management is still with us, and today we've been speaking about, the relationship between the global macros and what it does for people like you and me and our investments and portfolios, and why it's important to actually understand this relationship. So, Kirtan, we've spoken about, what's happened so far, what's happening now, and the impact on equity. But there are several other asset classes. So let's talk about bonds then. What has been the impact on bonds and how does it all come together?
So, Sumaira, while we talk about fixed income, first we have to understand the relationship between interest rates and the value of the bond. Right? And you would have heard a lot of us say that they are inversely proportional, right? What that means is if interest rates are going up, then any bond which is listed will fall in price, right? So let's say if today I issue a bond which is at 8% and issued to you at 100 rupees, if interest rate in the market goes up, right, I will still be making that same 8% and not the higher. Yeah. So my bond will start trading at 95, 90 in the market, and that's how they are inversely proportional. So what happened when the pandemic came was interest rates were slashed, and because interest rates were slashed, that worked out in advantage of the fixed income market. When interest rates went down, the value of those bonds went up. But what's been happening now is you see that globally interest rates are going up, right? You've seen US increase interest rates upward of 3%. India has done almost 190, 200 bips, right? You've seen UK do upwards of 2% interest rate hike, right? So now when interest rates are going up, you saw in 2021 that the fixed income market didn't really do very well because when rates went up, the value of the bond fell, right? And which is why you saw that the longer duration funds, like we call in the mutual fund space, they generated hardly 2-3% return the entire year, and you saw the liquid fund kind of category give you 4-4.5%. But largely last year they didn't do anything larger than that. Now what is happening is interest rates are going up. Central banks are trying to do the opposite of quantitative easing, which is quantitative tightening. They are sucking liquidity out of the system. And hence 2021 was not very favorable for fixed income. But now, specifically in the Indian context, Sumaira, I think we are very close to interest rates largely topping out, right? So we probably might have another 35 bips and then a 25 bip kind of rate hike that is expected, largely if things stay where they are, right? So now, while we are talking about fixed income, Sumaira, I think we are at a stage where the interest rates are kind of topping out in the Indian context, and now fixed income will behave slightly differently the way they did in 2021. So probably now is the time where interest rates might top out, and then you might see interest rates falling, and when interest rates starts falling, you would see bonds giving you capital gains, right? So this is probably the time to start focusing a little allocation towards fixed income.
Reviving
which didn't happen in 2021, Sumaira.
Okay, so we've got covered equity and fixed income. What about currency?
So Sumaira, so we've heard, while we spoke about other asset classes, currency was the most discussed topic globally in 2021 and 2022. Now, there are 2-3 aspects on currency that I think we should know of, right? First, we said that inflation is going up, right? Now, whenever inflation goes up, your commodity